Thank you, Mr. Neal. Mr. Paulsen is recognized for 5 minutes.
Thank you, Mr. Chairman. I don't think many of you maybe touched on the component of the treatment of deferred foreign income upon the transition of the participation in this exemption system of taxation. So let me ask this. The discussion draft talks about deeming all deferred income that's earned prior to the effective date to be repatriated, but with an 85% exemption, and that's payable over 8 years. Do you think that this treatment is appropriate, and what issues do you see as a part of that deeming that we should be considered? I mean, this is a 60-page draft of text. It's out there for that type of feedback. I mean, is this the right approach? You can just start off, Mr. Harrington, if you want to comment, and all the panelists.
Sure. Thank you, Mr. Paulsen. I do touch on this a little bit in my testimony on page 8, but I think the answer on this is really one of process of elimination. There really is no right answer here. You could effectively say the participation exemption is going to apply going forward, so all the old earnings can come back exempt. I mean, that has revenue issues, that has sort of effects in terms of how people would respond. You could just simply say, well, we're going to make you keep separate accounts, and I think Paul touches on this to a certain extent, the details on this as well. But you could just say, let's have a two-track system for a long period of time. That's not really a good answer either. Then again, sort of by process of elimination, I think you wind up where you are, which is, where the discussion draft is, and that's you have to have some sort of forced repatriation. It's either voluntary or it's forced. Obviously, I think people would prefer a voluntary repatriation because there will be sympathetic instances in which someone doesn't have the cash to bring things back, and I worry about that, particularly with respect to individuals. I think individuals are another sort of issue, but I mean there are fairness issues about telling people to did you have to bring this back, particularly people that don't have the cash to do that. So I worry about that sort of sense, but again, I think at the end of the day, it's running through. It's choosing your options. In terms of over the time period, what percentage it comes back, I think those are all, none of those are tax policy issues. Those are all somewhat arbitrary. Those are dealing with kind of what do you think is dealing with the fairness or unfairness of the approach. I think it's the more voluntary, you might make it less favorable. If it's compulsory, you have to make it more favorable. I think that's the tension.
Mr. Turf?
Excuse me. I would agree with Mr. Harrington's comments in that if you have a system where you have old earnings and to try and run a two-track system with respect to the old earnings and retain the old system and have a new exemption system on a go-forward basis is far too complex, and I would not recommend that. The difficulty then determines as to whether or not you wish to exempt old earnings. In the territorial systems adopted by Japan and the UK, they exempted old earnings. Or do you wish to go to a system whereby either elective or mandatory recognition of income of those earnings, but it needs to be done in a way that will promote and remove the lockout with respect to those earnings, because we want the cash to be able to come back to the United States at a low cost where it can be reinvested in the U.S. economy.
Mr. Norton?
Yeah, I would agree with what my fellow witnesses have said, and in particular, I think Mr. Harrington put it just right, that it's sort of a process of elimination. You don't want the complexity of maintaining separate pre-effective date earnings accounts, while at the same time some would say it might be a windfall to just start applying exemption to pre-effective date earnings wholesale. And so I think what the discussion draft has done on the transition side is just a really great compromise of the various revenue and complexity considerations. I would add one point on the 8-year period. I think that's a particularly important feature because I think what gets lost often in tax policy discussions is the distinction between earnings and cash. So we're talking about repatriation of earnings, and yet to pay tax you're going to need cash. And so some companies might say, how do I repatriate a building? To the extent that my foreign earnings were reinvested in a building, that's a little tricky to repatriate. And so I think 8 years gives you some time to kind of earn out of that and deal with the liquidity issues that might be raised by this big deemed repatriation.
Mr. Ostrauss, I know time is running down. But.
Yeah, no, I think because we do need to deal with revenues in all of this, so to the extent from a revenue perspective, you need to do something significant taxing the prior earnings, or at least a portion of the prior earnings, is a good way to go. As others have talked about, you might come up with a somewhat narrower definition of prior earnings, including earnings that are reflected in relatively liquid assets, because that is, in a sense, more fair among companies depending on what their earnings have been used to fund.
Mr. Sullivan, real quick, I know time's out.
Briefly, it's the 85% in the 8 years. They're arbitrary numbers. They're just about revenue. I just would mention that if this is being used to preserve revenue neutrality in the 10-year window, it will not preserve revenue neutrality in the later years.
Thank you, Mr. Paulsen. Mr. Larson is recognized.